Hello and welcome to a CMS Forex Daily Market Recap. I'm your fundamental market analyst, Nick Nassad. Today is Thursday, May 20th, 2010. Risk aversion was the theme of the day as investors fled commodities, stocks, and other risky assets that could lose value if Europe's economic woes worsen. Investors also piled into German and British government bonds, driving down yields as they worried about the implications of Germany's short-selling ban. The German ban, which was announced late Tuesday before being imposed at midnight, raised concerns about policy cohesion within the Eurozone as authorities struggled to move ahead of the region's sovereign debt concerns. There were also fears of a European-wide ban. But really, today's main action was a result of the market being extremely nervous over festering issues of Eurozone sovereign debt spilling across borders and possibly stymieing the global recovery. That put extreme pressure on commodity currencies such as the Australian dollar. Worries over systemic risk in Europe made many of the major indexes around the world, equity indexes, fall sharply, which only increased investor risk aversion. While commodity currencies were the big losers on the day, the US dollar and Japanese yen gained on safe haven flows. If we take a look at the Australian dollar Japanese yen pair, we see a very sharp decline in today's trading, which extends the fall in this pair that we had seen throughout the middle of this week already. Concerns that the crisis in the Eurozone will short-circuit the global recovery have investors moving out of riskier assets and resource currencies like the Australian dollar. We're seeing the yen rising as Japanese investors repatriate their funds in an unwinding of their carry trade positions. One of the very popular carry trades is the yen to Australian dollar carry. In this carry trade, investors borrow funds at relatively low interest rates and use them to purchase a currency with a higher yielding interest rate. However, during times of risk aversion, we see that carry trade reverse as investors liquidate those carry trade positions. So we are seeing that playing out now in many Japanese yen crosses. Australian dollar came under heavy pressure against the US dollar, extending its losses over this week. We had come into the week around the 88.50 area, but now we trade all the way down we had traded all the way at 0.8150 as today's low. Zooming this pair out to a daily chart, we could see that the last 5 candles have been very bearish, and we've moved below our lows seen in February around 0.86. That had been the low for our consolidation for this pair. Since we hit a high in October-November at the 0.94 area. So we broke below that in today's trading, and we moved sharply lower down to our current levels today. If we zoom this pair out even further, we take a look at our rally in this pair starting in March of 2009 up until our highs in November, and we plot a Fibonacci retracement. We could see that this low around 0.86 was a 23.6% retracement of this full rally, while today's low coincided nicely with the 38.2% retracement. So if we break below here and we continue this liquidation of carry trade and selling of commodity currencies on concerns over global growth, we might be able to move down to the very psychologically important 0.80 level, and below that we have the 50% retracement of this rise at 0.7825. Taking a look at the US dollar Japanese yen, so pitting the two safe haven currencies against each other, we see that the yen was actually dominant in today's session as we move below the 90.90 level in overnight trading, sliding all the way down to 88.95 before recovering somewhat. Pressuring the dollar in New York trading was a weaker than expected jobs report, which we'll take a look at in a sec. So right now it looks like the yen is king in terms of a risk as a safe haven from risk aversion. But again, part of this is likely the liquidation of carry trade. Interestingly enough, we saw the euro dollar actually gain in today's trading, especially in the late New York session, as we had resource currencies getting sold off. Investors and traders who had been short may have been short squeezed on many of their exotic currency pairs, such as the euro Australian dollar or the euro Norwegian krona, or even the euro versus the Brazilian real, which means that they had to close more profitable euro dollar short positions in order to cover losses on those other pairs. Also, there was news about an emergency ECB meeting and possible intervention to help boost the euro, so that gave it extra support. We actually moved above our 200 period longer term moving average in the 1 hour time frame, and we ran up against resistance at 1.26. That had been our level of support back here 2 weeks ago. and we broke below that level in May 13th, and now we're retesting it as resistance. So this would be a very important level to gauge whether the euro actually has some momentum to continue this rally that we had seen the last 2 days, or if we bounce back down from this level. If we take a look at the Euro-Swiss Franc pair, yesterday we had actually seen some intervention by the Swiss National Bank, and there's speculation that we saw further intervention in today's session. We had another 300 pip move after testing our low around 1.4140 in right before prior to the New York Open, and we had hit a high of 1.4450, which was actually above where this pair had been in recent trading. So that actually tests our high from back here on April 11th. Now, the wild swings in today's session were attributed somewhat to less liquidity in the market, and that means that smaller trades could push the market around further, so it may have been a good time for the S&B to actually flex some of its muscle and to try to get the Euro-Swiss Franc pair to move in favor of the euro. This rise came around 2 p.m., the bulk of the rise, and so that corresponded with the gains in the euro-dollar pair as well. Taking a look at another one of our commodity currency pairs, the US dollar Canadian dollar, we saw here rally in favor of the greenback as we touched the 1.0720 area in New York trading. That came very close to testing our high from May 6th, which had followed the quote-unquote flash crash in the US equity markets, but which also was one of the first times we saw oil prices come under heavy pressure as a result of risk aversion. So we saw oil actually down almost 8% at one point in today's trading, but it did recover to trade down around 3% by the end of the New York session. Still, the Canadian dollar remains pressured under all this risk aversion and lower commodity prices, and so we did see the greenback gaining. Now, whether we're able to move above our highs from May 6th would be similar to the euro dollar. Here, it'll be an important indication of where this pair may go next. If we take a look at the daily, we see that that high that we just pointing to was also an important level back in February. And so we do have a good amount of resistance setting up at this level. Now, I did say that risk aversion was increased in the U.S. session as we had a weaker than expected late jobs report. In that report, the weekly jobless claims for the week ending May 5th saw an unexpected rise of 25,000 to 471,000, which is a discouraging report in terms of the labor market. We'll have to see if such high numbers persist, and if they do, then it could mean a weaker recovery in the labor market, which would extend to a weaker overall recovery in the U.S. economy. Taking a look at the upcoming fundamental docket to end the week, tonight Japan will have its Bank of Japan interest rate decision, while overnight Germany posts final version of first quarter GDP as well as the IFO Business Climate Index and flash versions of its manufacturing and services PMIs for May. The Eurozone will also publish those figures. In the UK, we get data on the public sector net borrowing, which is important to the discussion around the fiscal budget in the UK. Tomorrow in North America at 7 a.m. we get consumer prices from Canada, which is followed up at 8:30 a.m. by U.S. retail sales. So that'll give us a reading of how consumers fared during April. And that concludes today's broadcast. For more news, videos, and analysis, please visit our site at cmsforex.com. I want to thank you for watching and wish you good trading.